for the hour today. Liz Young, Joe Terranova, Sarat Sethi, and Steve Weiss. Let's check the markets. Been an interesting session. Dow is doing quite well. No surprise, given what Chevron means to that. United Health, a big story today. We're going to get to all of that in a minute. By the way, famed energy trader Mark Fisher is going to join us exclusively in a few moments to talk about that move in crude today, how he suggests you should trade it. But Liz, I go to you first. I mean, first day of the Q2, do cyclicals continue to lag? Does tech continue to lead, even as the NASDAQ is pretty much at session lows right now? So how should we set the stage here for what lies ahead?
Look, I think actually this week is setting up to maybe be kind of quiet in the equity market in the sense that we don't have earnings starting.
Way to go, Liz.
I know. Sorry. Happy Monday, everybody. We don't have earnings starting yet. If we get a jobs report that's kind of a non-event on Friday, maybe nothing really happens. We're at this point where we're waiting for economic data. We're waiting for earnings data to either confirm or deny what we're all afraid of, right? And I don't know that we're going to get a whole lot that's going to happen in between now and Friday. When earnings heat up, maybe all bets are off. But I think this tech run could continue for a few more days. However,
days, that's it?
However, I would probably fade it.
Okay. So, Joe, if it only lasts a few more days, if Liz is in fact right about that, what does that mean then for the overall market?
Well, first of all, on Friday, we're all off. So I think Tuesday, Wednesday, Thursday is going to be particularly volatile as we try and handicap what the news is going to be on Friday, get ahead of that positioning, because very quickly you're going to turn to the other side of the weekend, and guess what's coming then? Inflation and earnings. So I think there is going to be a strong amount of activity this week. I also think right now the market's rallying on two things. It's rallying on sentiment and seasonals. And I do think that can continue over the next several weeks. I believe that you will see a little bit of a mean reversion in performance, value relative to growth, healthcare, energy, industrials, materials relative to technology. I don't think we're going to lose the technology trade at all. Growth has clearly, over the last month, made a return once again, on positioning. So I think the setup is, we've been in this range, 3,800 to 4,200 since November. The market appears as though it wants to go to the top end of the range and see if it could poke its head above it.
We're going to get back to energy in a second, so I don't want you to go deep there. But I do want to ask you, isn't this a reminder, if nothing else, of the inflationary pressures that are still out there? There are variables around the globe in different sectors that can still come back to bite you. And energy going back up north of $80 a barrel is one of those things.
Okay, ready? The viewers are probably going to shake their heads at this, and you might as well. I don't look at the news over the weekend and say, ooh, I'm worried about inflation. You know what I see? I see further pressure and contraction. I see rising interest expenses. I see tightening credit. And now I see rising oil expense on the consumer. It is very clear to me. The market today is focused on what? The market is focused on the contraction in the ISM manufacturing. A two-year treasury was 4.13. We're right around 4%, got down to 3.96 before.
Down.
So I think the news of the weekend rather signals that there's going to be more stress on consumers and on the enterprise sector. And I think that's going to ultimately lead to a Q3 that's going to look pretty ugly economically.
So, Sarat, I mean, let's remember where we came into this quarter, as you know, last week ended, and we're thinking about what lies ahead. Part of the rally, in part, had to be predicated on the view that the Fed was going to pause, that, you know, significant enough concerns exist still within the banking system in places and within the credit spectrum overall, that they're not going to be able to put the foot to the floor to the degree at which they once suggested they might. How do we think about that today?
So I think that's what the market's saying, and that's why your long duration assets actually had a rally, because basically implicit in what you were just saying is we're not going to be really raising rates as much as the market thinks. We've already got some contraction. We've already got credit contracting. Add to what happened this weekend. Basically, what OPEC is doing is we just want to maintain our prices. And I think prices were going down so fast, so quickly. So where we are now is kind of really looking to what Liz was saying was we thought we would be here in the first quarter. Now we're really trying to see, is this just being the can kicked down the road with earnings slowing down and the consumer slowing down?
So let me ask you this. Do we focus more, if we came in thinking, okay, Fed pause is in part what led stocks to have a pretty good first quarter, do we focus on that? Or do we focus on the fact that earnings are probably going to be tough and the economy itself is going to continue to slow? So even with the Fed pause, you know, if you march a little bit closer towards a recession that people still think is a base case at minimum, what does that mean?
It means you focus on earnings and you focus on companies that are going to have strong cash flow and have strong positions. And I think that's where you want to get a little more defensive with the healthcare sector, the staple sector, you know, areas where there's going to be cash flow and there's going to be less margin degrading than there is on other sectors.